Tyler's NextEra Energy Partners. We've talked about our concerns, the rapid change in interest rates, pulling back on their growth plan, the stock price crashing, the dividend yield shooting up above 12%. Some very real concerns we have with the company. And we're starting to see more and more material evidence that sadly, we're probably going to be right that the dividend is going to be unsustainable. We got a news drop, something they've done, some more debt they've taken on that's drastically increasing their interest expense. You ready to have another uncomfortable conversation about NextEra Energy Partners?
Hey, when the story keeps changing, we should be sure that we're checking in and being consistent with it.
Yeah. I still own shares too. So I think I have a pretty important bias in this that I need to make some decisions about what I'm going to do. And I'm leaning more and more towards selling, but I'm going to walk through the story of what's changed, what's going on. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link after this video. You're going to want to take a look at that list of stocks. Okay, Tyler. So let's go back in time a little bit. For anybody that maybe hasn't watched our prior videos, follow the story of what's going on, because this is a stock that's turned up on a ton of people's screeners and come up on the radar because the dividend yield has shot up so much. And a lot of people are thinking this is a good high yield opportunity. What's going on?
Let's try to condense down the previous few videos that we've done here. But basically,
previously on Investing Unscripted.
Yeah, now I'm going to do the really short version of it here, where it's a business that was a financing vehicle for its parent company, NextEra Energy. That it would buy assets from them at cheap prices and issue debt or equity in order to make this work.
Issue debt or sell stock on the secondary market. Yeah, one of those two things.
Issue equity, issue debt, sell stock. The idea is in low interest rate environments, it's all hunky-dory because you can probably sell it for less than what your cost of capital is going to be. However, in the past year or so, maybe 18 months, the cost of capital has gone way up. And with that, the possibility of selling these things is less lucrative as it once was, or at least the prices that it wants to acquire them from its parent, NextEra Energy. We started looking at this and saying that the current trajectory of the business didn't make sense based on the cost of capital environment that it was in, saying it could no longer issue equity because the dividend yield was too high. We were using the dividend yield as a replacement for its cost of capital, or a kind of a proxy, if you will. And so without equity, it could only go to debt, and you can only...
Let me explain that really quickly for anybody that's following at home, just to make it clear what we're talking about. The dividend yield's over 12% right now. If you're looking to acquire an asset and the rate of return on that asset, you're expecting a 10% rate of return, or even a 15% rate of return. If it's below 12% and you're selling stock that's yielding 12%, you're immediately losing money because the dividends you're paying out are more than the return you're getting from that investment. So that's the issue that's happened. And most of the assets that it was acquiring are 10 to 15% rate of return is kind of a good target for a high rate of return on these assets. So you can't, it's buying dollar bills for $1.20. You can't do it, right? It just doesn't work anymore. Go ahead.
Yeah. So with equity no longer a viable way to finance this, you can only go to debt. But debt is going up, and debt gets more expensive the more you take on because creditors think you're less reliable. So the combination of higher interest rates from the Federal Reserve, just making credit more scarce, higher interest rate, number one, and kind of a slightly deteriorating amount of debt, or more debt coming on, deteriorating the credit quality, means that your cost of debt goes up, meaning that any project that you bring on has to pay that much more to cover your debt service. So these were the things that concerned us, and saying like what the way that they wanted to grow their business didn't line up with the financing realities of today. And that's where we started seeing things start to dissolve. Management dialed back its growth ambitions, saying we're not going to issue any equity. And the stock dropped, and obviously the dividend got very high, yield got very high for a while there. But then the more and more you and I digging into it,
the dividend didn't move up. The dividend stayed the same. The value of the stock fell and made the yield on that new price look more appealing.
Dial back, that seems amenable. And then the more we dug into it, we started looking at when it had to start refinancing debt, because it's not like a mortgage. You don't pay it down over time. You have to refinance it when it comes due. And we looked at NextEra Energy Partners debt, and a lot of it was coming due by the end of 2026. A lot of that debt had very low interest rates. And so we started looking at it going, hey, if they have to refinance in a higher interest rate environment, that's going to eat away at that cash that they used to pay the dividend. And all of a sudden, things are starting to deteriorate even more, and the thesis is starting to break down even further. And that brings us to today, or the past couple of days. And this is where, Jason, why don't you let people know what has happened recently?
We first started talking publicly about this in late September, a few days before they announced that they were pulling back on their growth plans. And exactly our concern is starting to happen. So this is what happened. We see December 4th. We're recording this on December 8th. NextEra Energy Partners announced $750 million in debt at a 7.25% interest rate. Here's what's really important to understand. So they're taking on this debt at 7.25% rate. They are primarily going to be using it to pay off debt that costs 4.25%. Debt that's due in July and debt that's due in September of 2024. So they're going from a 4.25% interest rate to a 7.25% interest rate. On this one tranche of debt, that nets out to roughly $23 million, call it $22.5 million of additional interest expense from this one little tranche of debt that they're rolling, is the best way to think about it. That might not sound like much, but the total dividends paid out are about $722 million over the past 4 quarters. That's a little nibble right there, just a little nibble away from that. And Tyler, I think the point is, this is just the beginning. This is the tip of the iceberg.
Yes.
Of the total debt profile that's going to be rolled over the next couple of years.
Yep. As we talked about, that over basically the vast majority of their debt needs to be refinanced by the end of 2026. So we're 37 months away from the end of 2026. So when you look at that, let's be conservative here, and let's just assume, hey, maybe interest rates don't change. But put on the conservative investor in us and be like, well, because if you're doing this for dividends, you're probably a conservative investor, and say, if you have to refinance all of this debt at something like 7.2%, which you just did, that is a huge uptick in your total interest rate.
Let's review all the debt and let's talk about the real implications here, Tyler.
Yep. So a very large chunk of it is at the very top there, $1.6 billion of what are called convertible notes. And at the current price, they're probably not going to convert. Basically, stock price needs to be above $95 for them to convert. So let's just say low probability of that happening. You go from 0.78% interest rate to 7%. That's a huge uptick, right? Then you've got the rest of those 4.2% notes. A large chunk of those over the next 36, 37 months are also going to come due. So there's another 20, 30, maybe even $40 million in interest rates and our interest expenses, And so you start piling those all together and you're looking at 100, 150, $160 million in additional interest expenses annually.
Just that top line, the convertible notes, just the convertible notes alone, you're looking at roughly about $100 million a year in additional interest expense from this one tranche of debt that you would acquire, that you would be taking on. You start taking, so again, this second line here, we just knocked off about half of it, right? Less than half of it, 740 million roughly is what they're paying off. So there's still over $1 billion of this that will need to be paid off. So you're looking at another $30 million in interest expense. So that's 130 million just right here. You start getting into some of these.
That's further down the road. And I think it's fair to say I don't think we have to worry too much about those because that's 3 years out. Just focusing on those two, we just said $150 million worth of additional interest expenses.
$150 million off of a $733 million dividend. Yeah, that's a substantial amount of cash flow that has to come from somewhere, Tyler. Right. And that's the key, is that you can't just not pay your debts, but you can not pay your shareholders. That is a choice the company can make. And it's looking more and more like this is a dividend trap, right? This is not a great opportunity to capture high yield. If you're investing for income, I think people should stay away because of that substantial risk. If it's income you need, this is a massive risk you're taking on. Now, I will say this, Tyler, and I'd love to hear your thoughts on it. I do still think that there is some risk-reward potential here, whether it's somehow they manage to financial engineer or maybe grow through this, through the repowering and some of the other things that they're doing. that they do manage to somehow maintain the dividend, even if they don't grow it, they maintain it. There is a risk reward play there. There's also maybe a special situation acquisition play where NextEra Energy makes the decision because of the economics and all of the challenges. We just need to roll this up, right? We're going to reacquire it. We're going to pull it back into the parent company. So I think in either of those situations, there is potential for decent return for investors, but you're also still acknowledging the fact that things could still go very sideways.
Yeah, I don't know if I agree with that. I get to be the stick in the mud here. If it's going to get rolled up into the parent company, I doubt
Okay.
it's going to be done at a significant premium based on some of the financials we just talked about. And if it were a special situation or the value on the existing assets, think that we're still a ways away in terms of the actual valuation of the business before I can say that. I know if we sometimes you use yield as a valuation tool here, but we've just admitted like the yield is not indicative of what the value of this company is because we expect the dividend to get cut. And so yes, there is a possibility down the road that this could be valued asset or underpriced assets, but I don't think that's the case at this current valuation.